Thank you for tuning into this episode of the Advisor Trend Monitor series. My name is Sophia, an avatar on the FUSE research team. In this episode, we'll share a selection of highlights from our study, Alternative Products, the Advisor View. This survey is part of our Advisor Trend Monitor series, 6 deep dive reports each year exploring advisor sentiment on the issues that matter most to asset managers. Each report is built on surveys from 500 to 700 advisors and includes a 15 to 20 page written analysis, plus a companion data supplement. To ensure our data is actionable, we surveyed a representative sample of advisors. About 3/4 of respondents reside in the IBD, wirehouse, or RIA channels. We captured detailed demographics like assets under management, which we then used to cross-tab the data. This segmentation allows us to provide more nuanced and targeted insights for different advisor cohorts. First, it's important to note that availability remains a primary driver of usage rates. Wirehouse advisors universally report the highest access, particularly in hedge funds and private infrastructure, where they have a significant advantage over their peers. While private equity and credit show strong availability overall, RIAs and advisors with smaller book sizes generally see lower access levels compared to those managing over $500 million. Next, the data shows advisors are moving toward a 10% target allocation within the next 2 years. High net worth advisors managing $500 million or more are already leading this trend with current allocations near 10% and plans to reach 13% shortly. Most advisors implement this using 3 different managers to build out their portfolio segments. We are observing a significant shift away from liquid vehicles like publicly traded REITs and towards semi-liquid or private strategies. Cryptocurrency and digital assets lead this shift, with 40% of advisors planning to increase allocations. Interval and tender offer funds are also seeing a notable uptick as advisors seek better alignment with underlying mandates. Private infrastructure is gaining similar traction despite lower current usage. From a rationale standpoint, diversification clearly tops the list for using private credit, private equity, and real asset strategies. In fact, it's the only rationale cited by a majority of surveyed advisors. Other commonly mentioned reasons, such as higher income potential and long-term growth, also make sense. For private credit, its low correlation with public markets aligns well with the diversification that advisors seek for their fixed income investments. With private equity, access to non-public companies plays a key role in long-term growth potential, especially as the number of publicly traded companies continues to decline. Finally, for real assets, inflation protection stands out as an important hedge. Finally, nearly 2/3 of advisors say current materials are lacking, a frustration shared across all age groups. To stand out, asset managers must address key themes like client-friendly simplification and transparency regarding fees and risks. Many advisors are also looking for real-world portfolio context and better visual collateral to help them implement these strategies. If you're interested in viewing the full data and detailed breakdowns by channel, team size, and advisor profile, please complete the short form below to request additional information or purchase the report.